So just be inquisitive, take a look at how much money you have, like what's available out there, and, just figure out more ways that you can take advantage of what's available to you.
Hey, welcome to Uncommon State of Mind, where we debate different ways to leverage your next investment to create time freedom, legacy impact, and generational wealth in order to live that uncommon life. But in order to do that, you must be uncommon. My name is Joey, aka Mr. J Mace.
Hey, and I'm AD, also known as AD the Fly Realtor.
Cool. So today we're gonna have a two-parter because we have a lot of information, and we know that we're not going to be able to crunch it down to into the time that we wanted. So we're going to just create two parts and make it easier for ourselves. The main debate is we're pretty much going to debate which is better to get into your investment, which product is better to get into your investment, business credit and or loans. Okay. So before we actually get into that debate, we're going to go ahead and just explain kind of what our products are and the different variations of our products. And then in our next episode, we can go ahead and get into the debate. Okay. I'm going to go ahead and start by saying, how's your day, bro? Let's just.
It's cool, man. When I left LA, it was like around 60 degrees and I didn't have on any heater in the car. And I was like, oh, okay, I'm cool. Got my jacket on. I hit like Pear Blossom Highway, close to the AV. And I was like cold. I was like, dang, it's cold. I looked at the thing. It said 41 degrees. I was like, whoa. Like, man, 40 minutes later.
So we're filming in Palmdale, Lancaster area. And if you're from LA area, you're probably like, I got like literal snow here. Like it was snowy.
For real.
Like literally, like our mountains are still, and of course you see LA, they got a little snow on the mountains. Nah, it was real snow here. So when people come down here, it's a rude awakening.
Yeah, it's different. I forget I grew up here sometimes, man. It's a whole different world, man.
Whole different ball game. Today we're actually drinking light liquor today. We decided to change it up for the day, because, sometimes you need a little different taste, right?
Right. Switch it up a little.
Gotta switch it. Okay. So anyways, let's go ahead and get into our products. The first product we're going to get into is I'm going to go ahead and discuss the business, or not just the business credit, but the credit side in general. Me personally, I have a lot of experience with personal credit, business credit, and things of that nature. I've funded a lot of my businesses that way, several different businesses that way. And it's pretty insane, how many people do not have the education of the credit system and how many people are so scared of credit in general. I know I grew up, pretty much that way myself. Like I remember taking a class in high school, pretty much telling you how if you go buy a pizza off of a credit card, is that Palmdale High? If you go buy a pizza with your credit card, there's a scenario in which you'll pay like $150 for that $25 pizza if you just pay for it in cash. So like off of that lesson, I'm already scared. I'm like, what you mean I'm paying like?
We're talking about credit. I don't remember ever hearing about credit in high school, like outside of my dad and stuff here and there. Like, I don't know if
let's be honest though. The education system isn't meant to teach you.
It sure isn't. It sure
about any of that. You know what I mean?
It's not.
Credit, any loan, any of that. You know what I mean? So, of course, I had to go and find my own information on it. And once I learned more about credit in general, the less scared I became of it, and the more that I saw it as a tool to go ahead and help me, a tool to leverage to go and help me start my businesses and, get going on my entrepreneurial journey, right? So first thing we're going to do is break down 3 levels of credit that you could use in order to go ahead and, maybe put down on a property, even maybe start your own business, even if it's outside of real estate. 3 tiers, right? Tier number 1, you have your personal credit. Okay. So you can use your personal credit. Of course, if you want to get approved for a lot of credit, you want to stay above 650 or I believe it's like 650, above 650. You don't want any like outstanding items on your credit report, like bankruptcies and things of that nature. late payments, which always hurt you. If you're up at that 650 mark, it's a good chance that you could get approved and start building credit. Now, on the personal side, understand that personal credit is always going to be linked to your social security number. So they're funding you. They're looking at you through your social security number. And anytime you make any purchases with your personal credit, of course, that's going to reflect on your credit report, right? So, and the optimal level to keep your credit at, if you want to say you get credit and you've had it for a while and you want to apply for more personal credit, you want to stay under 30% utilization rate for banks to then look at it or for banks to look at your credit and be like, you know what, this is a good person to lend money to, for them to go ahead and, approve you for more credit. So if you're applying for more credit, but you already have credit cards and they're over that 30% utilization, good rule of thumb is to get it under that 30% before you go and apply for more credit, right? So there's that personal side. Also on the personal side, of course, when you get over that 30% threshold and you use more than 30% of your lines of credit, it also reflects on your credit report, and your credit report or your credit score goes down because it's over that threshold of that 30% utilization, right? Okay, so now we're going to switch over to business credit. Now, business credit is still tied to your social security number, okay? But if you decide to go ahead and go and spend money on that card, it doesn't reflect on your personal credit report. So that's one major benefit of using business credit opposed to your personal credit.
Is that why all these people on IG are talking about buying G-Wagons with business credit?
Yeah.
Okay.
Yeah.
All right. Thank you for the insight.
You could do that.
So they could go run up a check
right
on the business credit, or run up a bill, not a check, run up a bill on the business credit.
And it won't show up on their personal side.
All right.
Right. So, but there's a caveat to that. Right? The caveat is if you default on the payments to your business credit, since it is tied to your social security number, it will then reflect on your personal credit. But as long as the payments are up to date, then it'll never transition over. Okay? So that's one. Two, the utilization rate, you get a little bit more leeway in your utilization rate. So on the personal side, it's 30% utilization before banks start to look at you. But on the business credit side, you can have up to 50% utilization and you can still get funded with that, right? So they give you that good 20% space, 20% gap of extra cash usage because they understand that you're using this money to start a business, right? Those are two options, right? You have your personal credit, you have your business credit, but there's also a third option. There's corporate credit, okay? And corporate credit, this is not tied to your, social security number. This is tied to your EIN number. For those of you who don't know what an EIN number is, it's an employee identification number that you have once you start a business. It's set up as its own entity. So I think what's awesome about America in general, bro, is the fact that you can set up businesses and they are pretty much legally a whole other person.
Right. You know that's so mean? True.
Which is awesome. And I think when we were talking earlier, it's like setting up a trust, right? Like if you have all your assets, you acquire all these assets and you put it in a trust, somebody sues you, they're suing you. They can't sue the trust because it's a different entity.
Right.
So that's kind of the same thing with business, unless you pierce the corporate veil with, but that's a whole different thing. You can kind of pierce the corporate veil by using spending personally on your business, and then that's piercing the corporate veil, or a way you can pierce the corporate veil in which then they can go attack your personal assets. But that's a whole different episode. We're not going there.
Right, that sounded like some deep stuff.
Yeah. So
but I got a quick question. So then, all right, you mentioned personal credit, business credit, which is still tied to your personal credit.
So personal credit and business credit is still tied to your social security number.
To your social security number. So then what would be the primary differences between corporate credit and business credit? Because when I hear those words, they sound kind of similar to me, like corporate business. So what would be the difference there?
That the main difference was pretty much the fact that it's tied to your EIN and not your personal. So if you go ahead and spend money on the corporate credit, so you get approved for a corporate card, first off, when they're going through the application process and the underwriting, they're not looking at any of your personal information. You know, they're not looking at your social security number. They're not looking at any of your personal information. They're looking only at what the business has done and what the business's credit score is in order to approve you or deny you for funding. With that, that's a huge benefit because there's absolutely no tie. Say you default on the loan on your corporate credit card, well, they're only going to be able to go after the assets within the business. If that business happens to, you know, you default on the payments, it's not going to reflect on your personal credit report, right? And that's the biggest difference between business credit and corporate credit. Huge. So that's pretty much the main differences there. And then the biggest difference between business credit and personal credit is when it comes to utilization won't show on your personal credit unless you default. And also you have a larger utility usage rate that you can play with before other banks decide that you're more of a risk.
Okay, so like before it triggers any red flag.
Exactly.
All right, that's cool. That makes sense.
Okay, so those are the three different ways you can go ahead and get funded. And we're going to see what AD has over here with these loans.
Yeah, so as far as loans to invest in real estate or to just buy real estate in general, there's actually lots of loan options. A lot of people don't realize that. Most of the ones people probably know about are maybe FHA and conventional loans. But then you have various kinds of commercial loans. You have ARMs, adjustable rate mortgages. That's kind of next level.
Yeah,
but
you already lost me. I'm like,
right. It's kind of next level. Right, exactly. No, it's the acronym, adjustable rate mortgage.
Oh, okay.
But so pretty much like you can lock down a property for a specific interest rate currently, but then it could be a 3-year ARM, 5-year ARM, 7-year ARM, so on and so forth. At the end of that amount of time, then the rate is going to adjust to current
market prices.
Exactly. And there's different ways that like savvy investors get out of that. But anyways, not to detract too much from what we want to talk about. What I want.
Can we like make an effort to come back to that?
We can, but
not today. Not today. But like later on in a different.
Definitely.
Okay, for sure.
Yeah, because it's actually pretty cool, but it's not something you want to play with if you don't know what you're doing. But yeah, so for our purposes, because I know most of us here are all beginners, we're going to focus on FHAs, FHA 203K loans, and then also DSCR loans. So first off, we got your FHA. The FHA is the Federal Housing Administration. They have these loans that you have an opportunity if you have your credit score would need to be above 580, which really isn't too much to ask for. Obviously, the higher, the better. But if you have a credit score of at least 580, you would be able to have a down payment for a property at 3.5%. 3.5%, whereas like the standard conventional loan is 20% off top. So that's a good way to get into a property. The cool thing though is that with an FHA loan, you actually can acquire a 2 to 4 unit multifamily. And you know, me being the multifamily deal finder, I'm always interested in what can get you into a multifamily.
Shameless plug number.
It's not even
IG.
about that. It's just to let you know that that's a real good tool to utilize.
I ain't mad at you.
So it's not just, you're not just going to pay the down payment though. You still have your closing costs. They typically say factor about 5% for closing costs. So let's just call it 10%, 3.5.
So 5% of the overall
purchase price
of the property.
It would be considered for closing costs.
Okay, got you.
Yeah, so then we got your 3.5% down payment, you got your 5% closing costs. Let's just call it 10%. So to keep it very simple, if I'm trying to take down a property that's $500,000, $50,000 is a good amount to like understand that I can go in and get this on an FHA loan. All right, so that's number one. There are certain stipulations, though, required for an FHA loan more so than a conventional loan, because since it is an owner-occupied loan, and they, for the most part, most people using an FHA, it's probably their first property, there's certain things they want. They don't want the property in bad condition. It needs to be like, and it doesn't need to be pristine, but it does need to be completely livable, whereas there's nothing major that needs to be done. And certain things that do need to be done, you probably need to negotiate with the seller to either get that done or to leave money for you to get that done.
So say you wanted to flip a house, so FHA loan wouldn't be a good product to try to flip a house? Or
for the purposes of our conversation, no. But if you're looking at a long-term flip or like a live-in flip, that is something very possible. But that, like, our typical flipper isn't going to use an FHA to try and flip a property. It's just too much going on. And then there's they call it a seasoning period, where pretty much you have to be in the property for a certain amount of time before you can even like do something different with it. So that's why it's like things like that gets a little more tricky.
How long is that? Typically, how long is that seasoning period?
The seasoning period now, I know it actually recently I was just hearing that it's just been increased. So it depends on the lender or the bank that you're getting your loan from, but really it's like usually 12 months. You can find people that will do it in less. It really just depends. But on FHA, it's usually 12 months. Yeah, almost always. So then after that, we have your FHA 203K loan. What's really cool about the 203K loan is that the lender can factor in up to $35,000 in repair costs. For the FHA loan, how I mentioned, it needs to be extremely livable. Nothing major needs to be done. That changes with the FHA 203K. So you still have the opportunity to get a 3.5% down payment, but then in your loan, they work in repair costs. So that's actually really dope, because then you have a better opportunity to buy value. By buying value, I mean like you purchase a property with equity. The only way to purchase a property with equity is to buy it at less than it's actually worth, which of course we all know, if you buy a distressed asset and you increase the value of that asset, then you just bought value, you bought equity.
So quick question, just to kind of come up with a scenario. Well, what was that last loan product we're talking about? It's called the FHA
203K.
203K. So they kind of factor in repair cost.
Yes.
Okay. So say that I'm looking at a property, I'm going for that $500,000 house, right? Or multifamily or something like that. I would get approved or I have $50K to go ahead and put down, right? Is that what you said? It's around?
Well, that'll be your down payment plus closing costs.
Okay, for sure.
So yeah, that'll cover pretty much everything you'll have to pay for to get into that property.
Okay, so say I'm buying it for $500K, but after fixed up, it'll be worth like $600. I'm not sure if it even matters, but like knowing that it's gonna cost, I don't know, 30 or 40K to get repaired, you're telling me that loan product will factor those prices in, that 30 to 40K repair cost?
Up to 35,000.
Wow.
So yeah, so if it's gonna be over that, you would have to either front that money yourself, or it could be a gift from somebody, you can borrow it from somebody, but the lender themselves will approve for 35,000 extra for repair costs.
Okay, awesome. So all I have to bring to the table is my 50K.
Yeah, you're down and you're closing.
Yeah, if I for 100% know that this property is going to take about 30 to 35K of repairs, as long as I have my cash, then everything else is going to be taken.
That's all going to be tied into your loan.
That's awesome.
It really is, actually, to be honest, especially for a beginner to be able to get into a property and buy value like right away. It's usually not that, it's not that easy for someone just starting out to be able to do. So it is a real cool option. And one thing that I think is really cool about it is that the like FHA loans, they actually protect you. Like you have a lot of protection, because the lender isn't going to allow you to borrow money on something that they don't feel would be a good asset down the line, So the contractor has to be, you already have to have the contractor beforehand, and they're already going to go through and figure out how much it's going to cost. Like there's typically contractors that specialize in FHA 203K loans. I don't know if people who don't do them, like I don't think there's contractors who like don't do 203K loans on a regular basis and just do them sometimes. I think most contractors who do them, it's kind of like that's one of their specialties. But yeah, so it's just like purchasing a regular property. Like you're gonna have inspections and everything beforehand, and they're gonna get a good idea of like what the cost will be once you acquire the property. And then the thing is, they don't get paid until after everything's done too. So it's like there is incentive for them to make sure they do it properly, they do it right and everything like that. But yeah, like I said, it's a really good option for beginners to get into the game and try and find a way to buy value. Because once you buy value, at least you already know you have that cushion. You know, you got that cushion of equity. Equity is pretty much like how much of that house you already have that you're not currently paying off anymore, if you know what I mean. So then that's number 2. Our number 3 loan would be the DSCR loan, debt service coverage ratio. I wouldn't quite say this is a beginner loan, but beginners can take advantage of it. The best thing about it is, like if I compared it to the credit, it'll probably be like the corporate credit, where it's really not tied to you necessarily. Like you get into one of these loans, it doesn't show up on your report. But the downside of it is that you can't get in for 3.5%. It's actually a 25% down payment. So that does seem to be a hefty amount. It does get a lot higher with that. So if we're using that same example of a $500,000 property, now your down payment would need to be about $125,000. So that significantly increases what we're doing in our capabilities. But the cool thing about it is that your ability to get approved for that loan isn't based on your credit, your personal credit or anything like that. It's actually based on the ability of that property to perform. So pretty much what they're looking for is if the rent you'll be getting from that property covers the loan, then like you're pretty much in the clear. Like to keep it completely simple in layman's terms, like that's all they're looking for. Like they're not even worried about how much money you'll get. They're just like, okay, like, will the rents cover us? And you can get that property. So that's a good opportunity for a beginner who wants to maybe partner with somebody. If you want to get your parents involved, your friends, whoever it may be, that'll be a good opportunity because it really is a superior loan.
I like that.
Yeah.
Okay. So that's all 3 of the products you have?
That's the 3 of the products that I want to discuss today.
Okay, so we're going to go ahead and end this episode here because it's jam-packed of information.
Right. It's a lot to chew.
A lot to digest, but we'll go ahead and just do a quick recap. So on the business side or on the credit side, you have your personal credit, which is tied to your Social Security and does show up on your credit report and can affect your credit score. You have your business credit, which is also tied to your Social Security. It does not show up on your personal credit score unless you default on those payments, in which then it will. And you also have a larger utility rate to utilize compared to personal. Personal is 30% utility. Business credit is around 50% utility before any red flags come up. And then you also have your corporate credit, which is not tied to you personally on your credit report or your Social Security number. It's tied to your EIN number, which is your employee identification number, which runs as its own entity, in which, you know, there you can have a little bit more fun with your cash. And it doesn't show up if you utilize all the cash there, which I believe is a more superior one, but you can actually utilize all 3 if you'd like. Then AD, I'll let you summarize.
Yeah, and then so to summarize the loans I discussed today, we have the FHA, the basic FHA loan. You can get into a property with 3.5% down, which is a great opportunity, like I said, for anybody starting now, for anybody beginning. And you don't get one of those in your life. You can get multiple FHA loans. That's a different conversation. But so we have that. We have the FHA 203K loan, which is very similar to our first product, the FHA, but this one, you actually can factor in up to $35,000 in repair costs that will be part of the loan, doesn't come out of your pocket. So that's really dope. And then lastly, we have the DSCR, debt service coverage ratio. That's a 25% down loan in most cases, especially if you're just starting out. But the cool thing is that it doesn't require your personal credit or how much you make in order to qualify. What qualifies for that loan is the amount of money that that asset produces for you.
All right, so AD is about to give us our B for the day.
My B for today is going to be inquisitive. So we just discussed different credit options and also different loan options for you as a beginner to start your real estate investing journey and or business. So just be inquisitive, take a look at how much money you have, like what's available out there, and, just figure out more ways that you can take advantage of what's available to you. So be inquisitive and go out there and learn.
Yeah, dude, we dropped a lot of knowledge. It's super jam-packed. So if you're inquisitive with this episode and you just look up the things that we've talked about, and if you want to go verify it for yourself, do so. But yeah, those are our B's for the day. Be inquisitive, be you, be uncommon. Guys,
All right.
stay up.